So all you need for the gold miners to be a good investment conceptually is for gold and silver to hold more or less in their current range. Gold, anything above $1,700 is a profitable place for most of the big gold miners.
Thanks for joining us for part 2 of our interview with monetary analyst John Rubino. If you haven't yet watched part 1 of our discussion with John, in which he explains why the dollar is fast becoming dangerously devalued in a manner that could soon have very serious and long-lasting repercussions, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that John and our partners at New Harbor Financial share in this video. Oh, and if you haven't yet, don't forget to subscribe to this channel by clicking on the red subscribe button below. And now, here's part 2 of our interview with John Rubino.
So that's what you got to worry about now. And because of that, you need expert advice that is not mainstream. You can't trust a traditional financial planner who's using, this cookbook formula to allocate your money to safely do that anymore. So you need somebody who's going to, do what I said. Look at the hard asset side of the spectrum and skew in that direction. And that's something that the average stockbroker or financial planner would say is kind of alien and excessively dangerous because it's not well understood. But you kind of have to take that the conceptual leap right now in that direction. And because most people don't know how to do that, it's helpful to have pros that do know how to do that walk you through it.
All right, well, you're setting the New Harbor guys up just beautifully. So they're going to send you a really nice fruit basket after this video. But before we get to them, John, let's scratch into gold for a bit, because I know that that's an area that you do know well and have mentioned both previously in this video, but in a lot of your prior work. It's something that you've said it's one of the assets that's likely to be one of the best wealth preservers given what's coming. And as I mentioned a few minutes ago, I think it's got potential to actually be a wealth enhancer, a wealth accelerant. So, anything you want to say about either investing in the metals, your general outlook for them, and then I know you follow specific mining companies. We're not giving specific personal financial advice here in this discussion. Anybody who hears a company that John's mentions should do their own homework in determining whether it's a good fit for their portfolio or not. But John, if there are some companies that have your attention right now, I'd love to hear what they are.
Sure. Well, gold and silver don't think of them as investments. Think of them as money. They're the forms of money that humanity has used to preserve wealth since the days of the Roman Empire and before, and they've held their value throughout 3,000 years. So they compete not with Google stock or Tesla or something like that, but with the money that is in your wallet and under your mattress and in your bank account. So the basis of a financial life going forward needs a lot of cash, obviously, because you always need a lot of cash on hand. But that cash probably should be in the form of precious metals now, instead of some kind of fiat currency that's going to be inflated away by its government. So physical gold held in a safe place is really the bedrock of this new version of a financial life that we're advising people to adopt here. But we are in an unusual time now where gold and silver could easily behave like investments in the sense that they just go through the roof pretty soon. Because everybody realizes that the financial side of the ledger is a disaster and they want to get into the real asset side. And there just aren't enough ounces or tons of gold and silver to supply all the demand that will come from that, and their prices will soar. So that could happen, but that's not why you buy gold and silver physically. You buy it to preserve your purchasing power so that 20 years from now, what you put into it is still there. The way to more consistently actually make money and build capital in gold and silver is with the mining stocks. You buy shares in a company that has a bunch of gold and silver in the ground, and is because of that kind of a leveraged play on the metals. So you had Rick Rule on the other day, who gave some very good advice
He was
about
great.
investing
Yeah.
in gold and silver stocks. And what he said was that, yeah, you could put a huge amount of effort into finding junior gold and silver miners that nobody's ever heard of that'll go up 1,000%. But you'll end up with a lot of losers in that process too, because most junior gold and silver miners actually go out of business. They never really pan out. And you can get almost the same return by just buying the very best quality stocks in the sector. And so he pointed out, Franco-Nevada and Wheaton Precious Metals, which are a special kind of gold and silver stock called a streamer or a royalty company, where they don't actually dig the gold and silver out of the ground. They finance those little junior miners that we talked about, and then take a cut of what the junior miners produce on very favorable terms, because they're financing these junior miners at a time when the junior miners are desperate for cash. Because otherwise, not very many people actually want to lend money to a gold miner that has never actually pulled anything out of the ground yet. So those guys go do that, and they've made a lot of money doing it with very little risk. So they're the best business model in the gold mining sector. But the big, really high quality, really successful miners are also good, like Newmont and Barrick and Agnico Eagle. If you just bought a portfolio of those 5 stocks I mentioned, according to Rick Rule, who is the smartest guy in this space, bar none, you would do almost as well as a professional picking a wide portfolio of gold and silver stocks, maybe better than that professional. So that's fairly easy and fairly restful. Go buy those 5 stocks, and you're probably protected against a lot of the crazy stuff that your government is going to throw at you going forward.
Great. And I'm curious, and don't let me pressure here, but in some of our personal conversations, you've highlighted a couple of interesting individual smaller miners to me. And again, this is purely speculative money, folks, but going after the best of the best that Rick's list was really trying to capture the beta of the precious metals mining sector, which Rick and many others, yourself included, think is very high. And so for most people, just going after it safely is the best bet. But if you want to capture some of the alpha in the mining space, that's really where you get these smaller companies that, they either have a discovery that really pays off, or they have a mine that they've been getting ready. It finally goes into production and it turns out to be a really good producer. These mining stocks can do unbelievably well. A lot of volatility, a lot of uncertainty. But I'm curious, I know Great Bear is a name that you've mentioned to me. Anything you want to say about that company or any other companies like it, again, that are just sort of on your radar as interesting ones to research?
Yeah, and I should preface this by saying I do not take Rick Rule's advice. I'm just buying junior miners out there like crazy. I'm like a magpie now. I just hear about one to see about it and buy its stock. So I have this huge long list of junior miners, many of which are doing really well. And here's an example. Great Bear, you mentioned, is a really good example of what happens when you find a junior miner that works out. Because 2 years ago, Great Bear, which is a Canadian mining stock in the Red Lake district, which is a really prolific gold district in Canada, was this no-name, tiny little exploration company that whose stock was maybe 39 cents a share US. But they found some gold, and they found more gold, and they found more gold after that. And now the stock is like $14 a share. So it's gone from 39 cents to $14 in 2 years, which is, that's more than 20 times. I don't know what it is now. I've stopped keeping track.
Oh, that's almost a cryptocurrency return there,
Yeah,
John.
yeah. It's a Bitcoin-like arc. And what I think will happen with the junior miners is, first of all, the Great Bears, the ones that actually succeed operationally, will be 10 baggers all over the place. It'll be very easy for them to be 10 baggers, because the big companies, the other part of the story for juniors is that the financial fundamentals are great for large gold and silver miners. They're generating a lot of free cash flow right now, but they're not replacing their reserves. In other words, they're pulling out more from the ground than they're finding with their exploration programs. So they have to get new reserves somewhere. So for them to be having lots of free cash flow coming in and reserves diminishing is the best of all possible worlds for junior miners, because that means the big guys have to buy them out at some point.
Yeah, that's almost not a guaranteed exit, but it's a highly likely exit.
Highly likely. Like to take Great Bear. Now that's what everybody's waiting for. You know, the Great Bear will put out a phenomenally good set of drill results, and the market doesn't even care. Nobody even cares about what they're finding now because they've already found enough that a big takeover is guaranteed. So now everybody's just sitting there going, well, I'm not going to sell this, but I don't want to buy anymore either since it's up by 20 or 30 times. But I'm going to hang out and wait for that takeout, which will be a double or a triple, everybody thinks, from here. So that's the future of a lot of good junior mining stocks. And then probably what happens concurrently is that all kinds of generalist money sees the action in junior miners and says, oh, I want in on this, you know, and so they start buying anything with gold or silver in their names. And you get kind of a .com thing going where people don't even have to understand the nuts and bolts of the business. They just have to know that it's in that hot sector and they want a piece of that hot sector. So even there might be a stretch where even the crappiest junior miners go up, you know, 5 or 10 times just because they're in the sector. It's like how everybody was buying cryptos for a while without understanding the slightest thing about what Dogecoin did or anything like that. Gold and silver junior miners could have that same kind of a dynamic at some point. So, you know, as a kind of a compulsive speculator, I can't not buy those things. But the average person has to think about where they sit on the risk tolerance spectrum. And you know, and they should probably have some junior miners in the portfolio, and they just have to judge what kind of volatility they can tolerate. And if they can tolerate a lot, this is a pretty good place to speculate right now. You know, this is a place where fortunes will be made by the extremely brave.
Yeah, and John, you're really talking about like when the precious metals industry really has its next big bull run. And I know you've been around to see previous ones. I just want to underscore for folks, it's been a long time since the last one, and the precious metals mining space has been a capital destroyer for investors for much of the past decade. So I just want to make sure people are extremely eyes wide open about the risk factor that John is talking about in this space, which well, Adam, yeah, go ahead.
There's one thing that I want to add there before we stop. But right now, the fundamentals for the gold miners are actually really good because
that's where I wanted to get to, which is we've had this 10-year of really horrendous performance. But the industry's cleaned itself up. We're now seeing, you know, money come back into commodities. We're seeing, you know, currency devaluation by all this accelerated printing. All these things that seem to be sort of setting the constellations to a point where we could be seeing a next big run in the precious metal space. So with that backdrop, please say whatever you want to say.
Yeah. So you don't need the gold and silver going parabolic thing to happen for gold miners to be successful investments, because they're already at current prices generating lots of free cash flow, which is all you know, what else do you want in a stock other than free cash flow, right? Because they can raise their dividends, they can buy back stocks, they can make strategic acquisitions right now. And they're going to, or they already are doing that, but they will continue to do it on probably a growing scale as time goes on. So all you need for the gold miners to be a good investment conceptually is for gold and silver to hold more or less in their current range. You know, gold, anything above $1,700 is a profitable place for most of the big gold miners. So if gold stays there, which, you know, barring that stock market flash crash, gold ought to stay above $1,700 an ounce because the fundamentals are so good. And fundamentals for gold are basically how much money is the government creating out of thin air, how much debt is it taking on and encouraging the private sector to take on. And those are phenomenally positive numbers for gold and silver right now. And what are real interest rates? In other words, the interest rate on, say, the 10-year treasury bond minus the inflation rate. And right now they're very negative. Negative interest rates are also very good for gold. So the fundamentals are great, and there isn't all that much needed from gold and silver for the gold miners to be attractive investments. So it's a really good time for this sector.
All right, one big risk. Well, with that, John, if you're saying, look, you know, at current prices for gold and silver, the miners are making a good deal of money. It's a good, they're going to profit well from this. Putting on your prognosticating hat, where do you think gold and silver are headed in the next year or two? Do you think they're going to hang out around these prices, or do you think it's more probable they're going to be higher or lower?
Well, see, if I gave you some numbers, that would guarantee that the opposite move would happen. So I'm just terrible about this year ahead stuff. I've never been good at it, but the bigger trends are easier to discern than the short-term trends. Right now, the fundamentals are great, and a target price for gold, anything less than $10,000, I think would be unrealistic. It's going to go that high and higher. And here's the math for $200 silver. Silver is about 28 bucks an ounce, or really 27 today because it's down. But have gold go to $5,000 an ounce, and the gold to silver ratio, which is how many ounces of silver does it take to buy an ounce of gold, go to 25, and boom, $200 silver. So it's very easy to have both of those things happen. Gold could easily go to $10,000 an ounce when inflation really starts to ramp up, which it seems to be now. And silver could go up more than that to some number that seems totally unrealistic right now. So those are my long-term predictions. I have no idea whether it happens next year, the year after, or 10 years from now, but I think we get there based on the current trajectory of our financial mistakes.
Got it. Okay. And so I think that's a very good way to answer the question. And really it solves what I was asking for, which is if the miners are well positioned at these prices, they should be even better positioned at higher prices. And you seem to think the prices are going to be much, much higher at the end of this progression, however long it takes, in terms of the extreme devaluation in fiat currencies. So presumably, the miners should do well, at least well enough to keep up with the currency devaluation. But my guess is, and don't let me put words in your mouth, you think they might actually appreciate faster than the actual currency's devalue. They might actually be wealth creators. Is that accurate?
Well, I think they'll attract a lot of hot money, which tends to, lead to parabolic moves. So yeah, that kind of thing could happen. But, really with a highly leveraged industry like gold or silver, where there's a lot of sensitivity at the bottom line to the change in the price of the thing they're selling, you get really absurd numbers when you think about what the profit margin of a big gold miner would be if gold doubles from here. The numbers don't even make sense. They're so high. So yeah, I mean, that's all in prospect out there. These things can very possibly happen because each component is understandable and predictable. Gold ought to go up based on the amount of inflation that we're generating right now. That historically has been the way it's gone. The gold miners should generate massive cash flow if gold doubles from here. I mean, that would just be, they would probably see increases of 5 times in percentage terms what gold does from here. So if gold doubles, it would be a 500% increase in the rate of growth of cash flow for these guys. So, the numbers could get into the realm of almost a silly prediction. You don't want to predict something like that because you could be so wrong if you're wrong. But these numbers are totally defensible based on some very reasonable scenarios out there.
All right. Well, John, look, thank you so much for sharing all that. I could talk with you forever. I'm sure the audience would love for me to, but we've got to wrap things up here, at least this time around. But would love to have you back on the program soon and continue, if you're comfortable, drilling into some of the other interesting parts of the sector and maybe some interesting companies in addition to the ones that we've talked about already, just for people to go investigate and explore. But thank you so much. As we end here, where should people who have enjoyed this conversation go to learn more about you and your work?
Well, I run a little gloom and doom website called dollarcollapse.com, and there's a button at the top that says join our email list. Put your email address in there and I'll send you whatever I write on the site for free, and will not sell your information to anybody else.
Great. And one thing I'll say too is John does a very valuable service every day at his site, and he compiles sort of the top headlines that he sees on the web around issues like currency devaluation, where we are in the macro picture of the economy and whatnot. And so if you're looking for a really good digest of current news in this space, John does all the work for you, and he makes it available on his site and in his emails for free. With that, John, thanks so much for joining us. Look forward to talking to you soon again. And I'm going to go chat with John and Mike now, but hope to have you on the program again soon, John. Thanks so much.
Thanks, Adam. See ya.
All right, John and Mike, wasn't kidding about that gift basket for John. He really just put it right up there for you guys, right there on the tee. Lots of volatility ahead. Got to be a nimble, active manager of your portfolio going forward. Big believer in hard assets, particularly loves gold and silver and the gold and silver miners. It really just sounds like he is sort of describing your guys' approach. So Mike, I think I let you go first last week. John, why don't we start with you? What's your reaction to what John said?
Yeah, I'm scared because we try really hard to make sure we're not in our own echo chamber. So no, he's a very thoughtful guy, a very thoughtful analyst, and it doesn't surprise us at all that he comes to a very similar conclusion to ours. So I do say jokingly that we're scared when we hear people that agree with us, because it is it is helpful to challenge oneself often, and we try to do that very much. And the last thing we want to do is hear just reinforcing voices because we need to challenge ourselves. But no, I think he articulates a lot of the big picture things that we see and dive into the data and perceive and measure. So we'll welcome his voice along with ours in that regard. All
right. Well, why don't we, point of this part of the video is to talk about what you guys have seen going on in the markets since last week. But we have seen just today a little bit of a cooling off in the precious metals. Mike, let me hand it to you. But first, any additional reaction to John's material? And then secondly, what are you guys seeing happening in the precious metals part of the portfolio right now?
Yeah, hi, Adam. I'm just taking a look through my notes here. I really enjoyed John's talk. He talked about the fact that one of two things are going to happen: either another Great Depression or another runaway inflation, aka Weimar Germany type thing. And he further says that the central banks and the policymakers have to keep reacting. They have to keep shoveling money into the system. And I guess I'd just say, why? Why do they have to? We just seem to be living in this paradigm where we just assume they have to, because we know how it ends. He said that it ends in economic collapse or a runaway inflation. And furthermore, he said he thinks we're in the 7th, 8th, or 9th inning. So we couldn't agree more. It's just, my comment is that it's sad that we've been kind of pushed into a corner like this, all of us, and we weren't really asked our opinion about it, nor could we vote on it. So these policies are putting us in a tenuous place. We don't really know exactly what's going to happen. We think that probably some kind of deflationary collapse first, which is why we're holding a lot of cash. But we could easily be wrong, and we can go straight into hyperinflation, which is why we totally agree with John that that you should hold real assets: gold, silver, property, your own house, of course, usually, and then even some other property like rentals. And so I think we're living in the end game. The problem is that human life goes slowly compared to, or I should say reality goes slowly compared to the length of a human life or a career. So it can be easy to just think that things are going to stay this way forever. They're not. We're continuing to have very tight defenses. You ask, I think, about what the market's done. It really hasn't done much. We're just floating along at the all-time high, 4,200 on the S&P. Gold has been in a nice uptrend with the exception of today. We're still pretty conservative. We've got some small, very modest gains in our accounts this year, very low single digits because of some key sectors that we've got exposure to and some precious metal mining stocks. But we're looking for better opportunity. It's challenging because John talks about gold, silver. John Rubino talked about that, and we can't just put 100% of people's money into gold or silver. They can do that themselves, I suppose, and it could very well be the right thing to do. We're still of the mind that having some core position in gold, silver, 5 to 20%, plus a big piece of cash, take advantage of lower prices is the way to go. So we're going to keep doing that.
All right, great. And I mentioned the conference earlier. folks will see themselves this weekend, but there is it's not a universal, but it's a very common theme amongst most of them that they believe that the risks of the market getting away from the central planners are high enough to really validate holding on to a core cash position right now for exactly the reasons that you mentioned, right? I think almost everybody feels like the long trend, with perhaps the exception of Lacey Hunt, who is a noted deflationist and makes a great case for increased deflation or continued deflation going forward. But most of everybody else feels that the central banks demonstrated proclivity to do whatever it takes, printing wise, currency printing wise, it pretty much guarantees in the long run that the prices of most everything, particularly hard assets, is going to be higher. And even Lacey says, he's willing to change his outlook if the Fed changes its stated policy, which the nuances of that are covered in the conference. But even Lacey is saying, hey, look, I can see scenarios where everybody else who's recommending that higher inflation does prove to be right. So it's hard. And Mike, you mentioned two quick things I want to just mention here as we begin to get close to the end here. One is that we were brought along this journey, we as a populace, really without any say in the process. And most people haven't watched it as closely as we, but those of us who have been watching closely have really pretty much been brought along kicking and screaming, very much disagreeing with where things have been driven. And what's interesting to me is the Fed and the other world central banks as well, but the Fed is arguably the most important player in our national economy and markets, as well as the global economy and global markets. And we have no say in that, right? The head of the Fed is appointed by the president. And so we have a say by voting for the president, but we just went through another presidential election not that long ago. And there really aren't that many questions dedicated during the debates to, who are you going to put, what do you think the correct Fed policy is, and who are you going to choose and why are you going to choose them? We're not having those public debates. We just get a guy in there and he slams somebody in, and lo and behold, no matter the past bunch of administrations, all Fed chairs have pretty much operated from the same playbook. So it is very unfortunate that we are kind of unwitting and very much, I think, unwilling participants in how the ship of state is being run here policy-wise. I also want to mention something that John wrote about years ago that has sort of been intimated in the discussion here, which is the people that we have in place running our economy and our financial systems, they are used to the environment that they have run their careers in. This goes to your point, Mike, about the short span of a career versus the arc of reality. So all they know is what they've experienced in their career. And as John was saying, what we've had for the past 50 plus years has been this rising tide of asset prices while we've been in deflation or disinflation on the way down. There's really almost nobody left in a professional role who was in a professional role in the early 70s when we were fighting inflation. And so where I'm going with this is the musculature of the experts that we have in place right now running the system may be the exact wrong musculature we need in place for what the future has in store for us, both with increased volatility, but if we are going into a secular inflationary period, we have a system run by people who have never had to run a system during an inflation. And so that's going to create all sorts of unintended consequences, unexpected errors, bad decisions, et cetera. So, we've got this system that A, we didn't have a voice in putting in place, B, we don't like how it's being run, and C, the people who are running it, they may have exactly the wrong experience to take us through what's coming next. So sorry for the long diatribe, but I thought those points were all really important to make. John, let me hand the football back to you quickly as we wrap up here. First off, I want to thank you and Mike for being my co-hosts for the upcoming conference. Again, folks, that's wealthion.com/conference if you haven't signed up for it yet. But as we sort of begin to wrap up here, John, as you look through your crystal ball going forward, you hear John, kind of reiterate, this is the time to be guided by somebody who is aware of these macro risks and is looking at, your portfolio, every day and making sure that they are being nimble to how things are playing out here in this increasingly turbulent future ahead. For the folks that have been kind of managing their own money or unhappy with their current financial advisors, what would you tell them to look for in how to manage their money going forward in this new period?
Yeah, well, especially now when one can look in the rearview mirror. Perhaps folks have benefited by what has been almost an unabated rise, certainly since the lows of the COVID crisis last March. Looking in the rearview mirror and kind of celebrating that kind of move can be very detrimental to one's clear thinking about what lies ahead. In fact, we humans have a tendency to kind of extrapolate all manner of things into indefinite future, whether they're going up or going down. And usually most things in life, and certainly in financial markets, don't always continue in that direction, right? Maybe unbelievable to think the stock market ever goes down again, but it will. Rest assured it will. So what is really important is whether one is self-directed or working with an advisor. We think one of the very best questions you can ask is what is your buy and sell discipline? What kind of markers or data or metrics do you use to essentially adjust one's portfolio or allocation to risk or conservatism in a proactive, tactical way? Okay, it's easy to buy, it's hard to sell, and getting those decisions timing-wise right is very difficult. And we are the first ones to say it is not an exercise in precision. That it can't be, it never will be. It's about being in the neighborhood of right, in our opinion. But that discipline, because the alternative, frankly, is buy and hold things forever, and frankly, with today's robo-advisors and all kinds of financial technology, you can do that for free, and any better than a human can. So I would really ask someone to, firstly, what is their investment philosophy, and being truthful about their investment philosophy. What would it feel like to lose 50%, even though you made 30% over the last year or whatever, and be truthful about one's ability to kind of ride the ups and downs, because there is likely a very big down move coming, as we've already talked about, and we talk about nearly every week. And having a discipline to think clearly about stepping out of harm's way, not jumping off at the wrong time, and getting back in when things are somewhat more safe. And that is easy to talk about, hard to demonstrate, because it really comes down to data and systems and discipline. One thing Mike and I and our team do we try to come in here every day and as if we have no memory. What would we do today based upon what we see in the data and what markets are telling us? So.
All right. Well, I think it's a great way to wrap it up here. Great insight advice, folks. If you're watching, I think the key message to take from the arc of this conversation is it really is time for active management. If you've got the ability, skills, and time to do that yourself, great. Ask yourself the questions that John just mentioned there. But if you are looking for help, particularly if you're concerned about capital preservation or prudently growing your wealth from here, making sure that you're doing it in a very risk-adjusted, risk-mitigated manner, then go talk to a professional financial advisor who understands these risks. If you're one of the first people watching, if you're one of the people watching, one of these Wealthion videos for the first time, you may or may not know that John and Mike, through their firm, they offer a consultation to folks. Feel free to schedule one of them if you want. There's no strings attached. There's no obligation to work with them. They will just share their honest opinion of what they think you should be doing, given your personal financial situation. If you're interested in that, stick around at the end of the video. It's coming up in just a couple of seconds. All right, guys, as we wrap up, I will see you guys tomorrow. It's Saturday, June 5th at Wealthion's conference. It's going to be a great day. And for those of you watching, you're going to have great speakers. Lacey Hunt, Grant Williams, Stephanie Pomboy, David Hunter, Lynn Alden, Matt Tybee, Mike Maloney, and others. You're also going to get an awful lot of John and Mike during the day. So you can use that as sort of like a preview of kicking the tires along with them if you then want to schedule a consultation with them afterwards. All right, so as we end up here, folks, if you enjoy these interviews, you want to see more like the ones we just did with John Rubino, please click the subscribe button below, as well as the little bell icon right next to it. If you want to see who are having come on the program in future weeks, or if you want to suggest a guest you'd like to see on the program, just follow me on Twitter at MenloBear. All right, John and Mike, as we say every week, no matter what happens from here, we will be tracking it together. I'll see you guys this weekend here on the channel next week. And thanks for watching, everybody.
See you tomorrow, Adam. Thank you.
See you very soon, Adam. Thanks a lot.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.